Hello, and welcome to the NatWest Markets Weekly Watch. I'm Brian Daingerfield. Throughout 2022, central banks across the world have tightened policy aggressively to combat runaway inflation. But since the start of 2022, risks to the outlook from the growth side have increased for a number of reasons. First and foremost is the persistence of high inflation, which dampens real incomes, can reduce discretionary spending power, and has led to lower consumer and business confidence across the world. Additionally, geopolitical factors are also weighing on growth expectations, whether it be Russia's war in Ukraine or the persistence of China's zero COVID policy. But there's also the impact of the lagged impact from tightening that has already been done by central banks. The rise in interest rates that we've seen since the start of the year have started to clearly weigh on interest rate sensitive sectors across economies, particularly housing. So with that, we're starting to think about central banks shifting the way they think about their own tightening programs. We know in a lot of economies, inflation is still too high, but these risks to the outlook from the growth side are starting to have central bankers thinking about whether the pace of tightening needs to slow or whether it's appropriate to consider pausing monetary policy tightening overall. Now, when you think across global economies, there's really one word that encapsulates this idea, this evolution of policy towards maybe a later stage, a different emphasis of the cycle. And we call this the pivot. You'll hear the word pivot a lot in the markets. But one thing that's important to consider is that while a lot of central banks have policy decisions recently that may fall under the umbrella as a pivot, the pivot comes in different shapes and sizes across different economies. We think about the Federal Reserve meeting, the November meeting, which took place on Wednesday. There was a pivot in really a name only. The central bank did acknowledge that it may consider slowing the pace of its rate increases after delivering a 75 basis point increase in November. They might consider slowing as soon as their December meeting. But at the same time, Powell, the chair, pushed back aggressively against the idea that this was a change in tone, a thematic change in the Fed's fight against inflation at his press conference, saying that the terminal rate is likely going to be higher than they expected when they last met back in September. So that was a pivot in one sense, focusing less on the pace of rate hikes and instead on the final destination. So if you think about it from the perspective of front loading, which has been the Fed's strategy for much of this year, trying to pull forward tightening and do the tightening faster, instead we're thinking more about a marathon of tightening where rather than a sprint, focusing on getting to the end point, but maybe taking longer to get there, getting to a higher endpoint, I should say, rather than trying to front load the tightening and get it all in as soon as possible. We also heard from the Bank of England. Now we are recording on Thursday, just after the Bank of England decision. And what we have seen, certainly in currency markets, has been a dovish reaction, with the Bank of England seeming to try and push back hard against market expectations. So with that, I'm happy to bring in our chief UK economist, Ross Walker. Ross, I'd love to ask you about the Bank of England, the market reaction today. Clearly, the Bank of England seems to try and push back against the market. What exactly were they pushing back against? And how are you feeling about the Bank of England's policy response today?
Yes, an interesting meeting because they did step up the pace of policy tightening, which might seem like a strange time to simultaneously try to send a more dovish signal, at least over the medium term. But that was really the surprising development today, the extent to which they pushed back against market rate pricing, which in practice probably means not exactly where rates are trading today or rate expectations are today, but where they were in the week up to the week before today's meeting. So they took out some of the extreme upward move that we saw after the UK mini budget when we had that chaotic market period, but nevertheless captured that elevated period of rates. So bank rate peaking at about 5.25% in the middle of next year. So essentially they're saying, look, that's probably excessive. So if 5.25 is probably a bit high, I don't think they're micromanaging this. I don't think the signal is that the peak's going to be 5. It's probably a bit lower. And maybe if we think about this in range terms, maybe they're signaling today they think they need to get to somewhere between 4.25 and 4.75%. And if we think in terms of the quarterly forecast round meetings, maybe by May next year. That still feels a little bit too hawkish to us, given the outlook for the economy. So we lean a little bit more dovishly, a 4.25% peak on our forecast in February next year.
So it certainly feels like the Bank of England tried to push back aggressively against market expectations that were already well above our own expectations for the BOE tightening cycle. So that certainly feels like it was an appropriate move on their part. I did want to ask you about the growth outlook as part of the BOE communications. They were talking about an extended period of contraction and how perhaps the market's own pricing, at least their pricing from a few weeks ago, of the cycle would maybe prolong that period of downturn. What are you thinking about the UK economy now with this move now completed? What are some of the risks around that? I know we have some very important fiscal developments on the near-term horizon.
Yeah, exactly. There are still quite a few big moving parts here that could affect the forecast. The fiscal situation, we have an expansionary policy setting over the next 12 months or so. Some of the tax cuts from the previous government have been retained, although most were reversed. But that does give some near-term impetus. When we get the main budget, the medium-term fiscal plan on the 17th of November, we expect a multi-year fiscal tightening, probably one that is a bit more backloaded in the sense that we think there will be a 2024, autumn 2024 election. So maybe, at least from a household sector perspective, some of that fiscal pain might be delayed a little bit. For the growth picture is still quite grim. We have a recession, the BOE, on the basis of that higher market interest rate profile, the economy contracting by about 1.5% next year. But even on their projection, the constant rate projections, if they just left bank rate at 3% for the next 3 years, they still think we will have a recession of around 1% in 2023 and basically a flat economic growth outlook the following year. So it's still going to be quite a tough economic environment. And of course, although they have to factor in that weaker medium-term growth profile, they're still warning about tight labor market conditions, elevated domestic price and wage setting. So, they are still on, to be clear, that there was a dovish shift today, but they are still on a hawkish policy setting. And we're still looking, well, in our view, at least another 100 basis points, maybe 150 basis points more of tightening still to come.
I feel like this really encapsulates the challenging environment that we have for global central banks, where they need to continue to tighten, or at least they feel like they need to continue to tighten because you haven't seen meaningful progress on wages in a lot of economies, including the UK and the US. You really haven't seen any significant loosening of labor markets. So from that perspective, it feels like they need to continue to signal that policy tightening is going to continue, but there are these risks to the outlook. And it's clear that central banks are maybe struggling a bit with trying to balance those two factors, certainly the Fed and the Bank of England among those, but it's certainly not unique to them. We've seen across the G10, the RBA in Australia, Bank of Canada, and even the ECB to an extent at their most recent meeting, seeming to suggest, there might be some room for adjustments within an overall outlook of needing to continue to be aggressive to try and ensure that inflation returns to target. So with that, I want to thank you very much, Ross, for joining, and thank you to our listeners for listening. If you enjoyed this podcast, please be sure to like and to subscribe to our channel for additional NatWest Markets strategy content. Thank you very much.